Well, absolutely no reason to sugarcoat it, y'all. That was probably one of the worst weeks that we've had for interest rates in quite some time. We knew going in that it was going to be extremely volatile. We essentially had no data, right? Other than Thursday initial jobless claims. So, what was everything going to hinge on? The conflict and the price of oil. And given that the conflict continued to escalate, which we anticipated, oil did the same. And the 10-year Treasury just moved lockstep with it. And the only reason it moved lockstep with it is, once again, we had very little data. The big thing this week was just the geopolitical events. Oil was jumping up to nearly $100 a barrel yesterday. We saw the highest level in interest rates that we've seen in about a year and a half. And all of that made a slight correction today. Now, does that mean we're out of the weeds? Absolutely not. We have a long haul to go. Next week, we do have some very significant data that we need to pay attention to because we are going to get back to data driving the marketplace next week. Although oil will play into it, it is not going to be the determining factor. So who am I? My name is Kevin Weedmark, aka the Mortgage Mouth. Each and every day I bring to you with what happened in the marketplace, how it affected interest rates, what do we got coming up, should you float or lock? And I'm doing that with over 20 years of experience in both residential and commercial financing on a nationwide level. You need help, make sure you reach out. So coming next week, we have PCE, which is the Fed's main indicator of inflation, but it comes the day after the Fed funds meeting. That is going to be the biggest news because the Fed and their vernacular and their policy drives about 65 to 75% of where that 10-year Treasury sits and where inevitably interest rates sit. So we want to make sure that we pay attention to that meeting. Now, there's about a 36% chance that people believe that we're going to see an increase in interest rates. I don't think they do anything. I think they're going to remain very hawkish. And I think by doing that, they're already going to keep rates elevated, which is exactly what they're looking for. So that's coming at us next week. Thursday, we do have PCE, like I said. And then, of course, we got that initial jobless claims. So should you float or lock? Absolutely in the float camp, unless you're out there over the weekend looking to make an offer on a home, then you want to make sure that you do it with seller concessions to offset those closing costs. If you're doing a refinance or even a purchase, you may want to consider talking with your lender about utilizing yield spread premium, offset all those closing costs, create affordability for yourself by saving thousands of dollars. So when interest rates drop in the future, you can take advantage of them then and not pay closing costs twice. You need anything over the weekend, please don't hesitate to give me a call. You want a topic covered, let me know. Drop a comment and make sure you hit that subscription button. All right, y'all have a fabulous weekend. Be safe out there. Cheers.